Hey traders, Parker here with the end of the day recap. Right now, what we're looking at is S&P 500. What you can see right here is a bearish engulfing candle in this downtrend. The SPY made a new high from this. It broke out of this range of candles right here, and it actually filled this gap. But you have another gap right here that it basically just got stalled in and couldn't break above, and it came back down. Most of this was in regards to the Fed Chairman Powell speaking, talking about a 50 point rate hike. And this was the result of it. And it really brought down the entire market. So I just wanted to go over how to use the sector rotation model, or in regards to the sector rotation model. And I explained everything that was on here earlier and the entire thing. But I wanted to also say this is going to be available once I get done making the last few adjustments to it in a bundle. Everything on the screen you're going to be getting. You have the upper model. You have the three move average momentum. You have this. These triangles actually are the I call them anomalies, where volume and price differ, or there's a divergence between price and volume, and it's one of the things that Wyckoff talked about. And you have your sector rotation labels. You have the actual visual aid with its labels as well. And then you have the advanced volume labels, and then you have the true volume buy sell pressure with this average. And right now I have the average set on 10. And so I wanted to go back to the pandemic because it's going to be the basis of what I'm going to talk about today, or talk about at this point. And also, I want to look at this last number where I have MDiff. It means market difference. And basically, it's where this thing is in between this. Anyway, it's the space between its ratio minus the S&P 500 ratio. So the S&P 500 is right here, and it's no, that's the futures. The S&P 500 is right here. It's just dark green. So its ratio right now is let's see. Its ratio number right now is at 44. So you're going to take the RS number of 87 and minus it by 44, and what you're going to get is 43.16. So utilities actually rose. And you watched the earlier video, I believe utilities was right at 40 or something. So utilities actually rose. Its market difference actually rose. Or you could say the S&P 500 actually went down, and that's exactly what it's saying right here. The S&P 500 was in a downtrend. So if if you remember from my earlier video, I talked about the utilities, healthcare, staples, real estate, all being in the defensive sector. And when the S&P 500 is making a low, these are going up because investors are buying up the different stocks within these sectors. And you can see how the defensive is also gone up as well. And this defensive is actually the average of these four. Of their RS number, the relative strength numbers. I'll add it up and divided by 4, and it gives you this relative strength of 85. And then it has a different market difference as well, 41. And it's going up as well. So that's how that is. But I brought it back over to the pandemic because I want to show you this, or I want to, I guess, re-explain this when it came to the recovery. So the first stocks that really recovered was the consumer, was the offensive sector. This gray square, the line versus square line, or this gray box line right here, you can see it, but you can't see it. But I'm gonna push this up so we can see it. So This gray and cyan line actually represents the offensive sector, and you can see how it started making recovery. And what's in our offensive sector is materials, industrial, technology, consumer, discretionary, retail, financials. Those six make up the offensive sector. So I took their RS numbers, relative strength numbers, add them all up and divide it by six, and you get that, and you get what's this that is off. It's RS number. So the RS number for the offensive is 42. It's pretty low. But when you match it up against the market, it's negative 0.263. So it's about 2.63% below the actual market. As you can see, all these are dark green and they're fading away. Industrials is still above 50. That's why it's this drab green color. And materials is actually still rising. So that's one of the sectors that's holding up the S&P 500. Technologies is basically dead in the water. Well, I'm not gonna say dead in the water. It's not like retail, which is really dead in the water. It's below 20. So it's white, but its short term average is above its midterm average of 21. The short term is 5, the midterm is 21. And my reasoning behind that is this. You can Google and you can go to or you can look it up anywhere. The average days in the stock market is over 252 days. So you divide that by 12, which is 12 months, and you get 21. And that's your monthly average. And you divide that by 4, it's 4 weeks in a month, you get 5. So that's my logic behind using them. 5 is my short-term move average, and 21 is my midterm average, and 252 is a long-term average or a year average for me. But a lot of traders like to use the 8 and 21 and the 9 and 20 and the 15. Anyway, they like to use all this stuff. But at the end of the day, everything is subjective. Whatever works for you, and it works because you believe it works, in my opinion. And I guess I need to do a risk disclaimer as well. I'm not a financial advisor. This is not me telling you to buy or sell. This is just me expressing my opinion and giving you food for thought. And but don't take it as gospel. But just think about it and give it some consideration. So the first one to really recover was the offensive sector, and that's full of the technology, all that stuff. And one of the reasons behind that was this model that I found online. It belongs to talkmarkets.com. So when the market actually bottomed, the first ones that went up was the bonds, the financial, discretionary, consumer discretionaries, technology, industry, transportation, basic industry, and so on and so forth. And capital good commodities and bonds start taking a downtrend. And basic materials, energy, and so on and so forth. But that's what happened after the bottom. You can see all this stuff right here is all in the offensive sector. So that's what happened. And then you see the defensive stocks rose as well. But the offensive actually took a kick back as well because they went below their 50 right here. But they recovered as well. But the full recovery came in May. And you can see that with the 3-move averages. 3-move averages are based on those same numbers. They're actually based off of 5. Let's see, 5, 21, and 63. I chose 63 because that's a 3-month average. 3-month average. So 21 times 3. So that gives you 3 months. And from what we seen on our diagram, it talks about 3 to 6 months ahead of economic cycle. So I'm pushing. That's why I use those numbers. You can use whatever numbers you want. And like I said, it's all subjective. Whatever works for you. This is what works for me. And this red and white line is the S&P 500's average, 21 period moving average, and it's on simple. You can go into the indicator and change this to whatever average you want it to be. And you can flip these numbers as well. You can see the 5 and 21s right there. You can change all of that. You can do whatever you want to do. But you can see how it made its recovery as well. When it was red, the S&P 500 was below its average. And when it's white, the S&P 500 was above its average, and it continued to rise as well. And you can just see this overall rise in all the indices. The one that's really lagging was the energy. Energy was the laggard. And if you don't remember, this pink line and this drab green color right here is the VIX. This is the VIX actual, and this is the VIX average. And you can look right here where the VIX just went to the extreme level, and then it cracked again, and finally went below. And you can see from the model, the S&P 500 just continued to rise. It had its bumps in the road, but overall it just rose, and the whole entire market just rose as well. And if you don't remember from the last video, the magenta color is the defensive sector. Blue is offensive. This cyan color is the average of the offensive sector. This purple color right here is the average of the defensive sector. And this yellow line right here is the actual energy, and this dotted line right here is the average of energy. Energy is by itself. It doesn't belong to defensive or offensive. At least right now, until somebody comes out with a better model and puts energy somewhere. And especially with everything trying to go electric, it may just go into the defensive sector, in my opinion, because it's going to be something that we need, especially with renewable resources and the Biden administration trying to push everybody towards electric. So going forward, let's go look at today. And I think I already explained. And let's go back. My bad. Let's go back. Come on, Thinkorswim. So we're going to go back. And what I wanted to show you was everything took a dip. But look at what's happening with energy. Energy is diverging from everything else. Energy diverged from everything else and started rising. And it really took off in what year? November 11, 520. And it basically stayed up from there. But it made its real play over here. I want to say this was October or September. Anyway, yeah, in September, it made its real play where it was beating the market. That's when they talk about people beating the market, is because they go into place or rising above the market. Or going up faster than the S&P 500, and that's what some of these. That's what you can use this last number for. Where is it in the space between it and the S&P 500? And the S&P 500's 52-week high, 52-week low, and in this whole ratio. And you can look right here. You can get a divergence while the S&P 500 was making a new going down. Energy was rising. It went above its average right here, and the S&P 500 went below its average. Even though it came back up, it never reached that new back towards its original high. And it's basically continued in that aspect, and that's all you've been hearing about is energy, or what else? Oil, electric, renewable. Some our energy plays anyway has just been up, and it made a little smudge right here, and this may have been the Ukraine. No, Ukraine. I want to say all that stuff happened in March. Well, May. I don't think it happened in February. May of, but what day is this? So February, probably February 24th is when it happened. When the Russia invaded Ukraine. I believe this is what this candle is, or yeah, this candle or that candle, one of these two. But that's what happened. That's what caused the downtrend, and the market actually recovered doing from that down period over here on the 16th of March. It started making a recovery from that, and you can see it right here. You see the cyan, and it's white because the S&P 500 is above its average. The offensive stocks were above their average as well, and the defensive stocks and the energy was rising above their averages as well. And the VIX was making new lows, which is what you really wanted to see. And that's one of the reasons why I put this downtrend, offensive downtrend, defense cross down, and VIX divergence. The VIX divergence, if you see VIX divergence on this indicator, it means that the VIX is going up while S&P 500 is going down, and vice versa. If you see a yellow label saying that SPY divergence, it means the SPY is going up and the VIX is going down. And you'll get one that says SPY downtrend, SPY uptrend, or VIX uptrend, or VIX downtrend. And then you got a VIX crossed above its average today. And you can see right here, this little red smidget is the S&P 500 in regards to the model. And right now it's below its 50% ratio between the S&P 500, 52-week high and low, and it's dropped below 50 again. And with the type of candle it actually made, this bearish engulfing candle, you can probably expect another down day for Friday. And anyway, investors don't like to be in the market over the weekend anyway, especially with all the volatility that's going on. And you can look over here, this implied volatility label up here is red, or it'll be green if it's below average, but it's above average, so it's red, which is saying that, hey, it's not good, or there's a lot of volatility, or people are really going into options during this time, or really just putting in puts on the market. So, and I might not have explained this before, but this is the advanced volume labels. It's I've done it on another video, and even though it's showing the monthly average has been buying, that average it's an average, so it's just taking some time to catch up. And you can see how the sell monthly average is actually going up. If I do another video tomorrow, I guarantee you this number is going to be higher than 41.86. And it's going to be showing you it's been more selling than buying, especially when you look at the actual candle. This is going to be the same because this is the day and we're on a daily chart. But if you was on the lower time frame, this would be for that lower time frame. And you can see how it's been selling. It's 56% selling for the week, or the weekly average is 50% selling, while the buying is 43%, and it's grayed out. And you're only using 20% of the 52-week average volume. And this is the 52-week average volume. So yearly volume and monthly average volume. And the last one, monthly sell volume. So it's just taking some time to catch up. And this will be the end of the video. And just like I said before, this is my area of support right now for the S&P 500. I guess you can say between 437.50 and 435.54, because you can see all this support area right here, or demand area that I drew. And if not there, the next one would be down here where I would see, and I'm hoping it doesn't come back down to 415. It's the next area of demand, and I put this label or this line right here is a 10% retracement with a 10% correction, I should say. Let me just move everything down. 10% correction. And when they talk about recession, not recession, but correction in the stock, it's either 10% or lower than 10% that makes a correction in the stock. And you can see right here where I looked at a double top. Somebody called this a smiley face. But anyway, it's a double top. And you're really just getting all this, when it comes to this cloud, it's just showing just bearish. It's not showing you anything positive. Yeah, it was positive over the short term, this 5 and 21. When it went up, you had a small amount of green with the 21 and 63, but it didn't last. It wasn't strong. And you want to find something that's strong when those clouds are really, really spread out apart like they are right here. Even though the short term crossed, the long term didn't really cross over. Even though you see it crossing over right here, it really didn't that much because the market just rebounded up. And that's one of the reasons why I use those numbers or those ratios, 5, 21, and 63. And that's pretty much the end of the video. I hope that you got something from this video. Like I said, this is not financial advice. This is just my opinion and just some observations that I made. I hope that they helped or help you giving you a better understanding of my way of thinking about things, and why I think the way I think, and why I designed this indicator, because I was getting beat because I was in a lot of these technology stocks, and I didn't understand the market rotation or the business cycle completely. But what they say, necessity is handmaiden of invention. I hope I'm saying that right. But that was my reason for creating this after I've done some research on the market rotation, and done some research on market rotation. And that's going to be the end of this video. I appreciate you guys taking the time to watch this video and to listen to what I had to say. If you haven't already, please like and subscribe. And I'm open for conversation. If you want to talk about something, leave me some comments in the description. Leave me something in the comment description in the comment section. And shoot me an email, cwparker23indicators@yahoo.com. And like I said before, I'm really thankful for everyone who's been supporting the channel, everyone who's liked and subscribed. It really means a lot to me, really being able to get my thoughts out at the end of the day and have worthy and worthwhile discussions. And I'm really interested in how other people think as well, because I want to get a better grasp and understanding how other people see things, because just because I see things one way, it doesn't mean it's right. And you really fall into that fallacy of your way always being right versus someone else's. And that's just pride. And in the stock market is no place for pride. It will humble you very, very quickly. But this is the end of the video. I appreciate you guys. Y'all have a great night and wish you well in your trading.